How to make money in the stock market. The stock market is a place where you can make money. It's important to know how to make money in the stock market before you start investing any of your money. If you're going to invest time and money, it's important that you can tell the difference between stocks that will yield a higher return than others. When investing in equities, the most important thing is to find great companies with sustainable competitive advantages. The best way for an investor to do this is to learn about what makes a great company and then study the quality of the management. The 3 qualities of great companies. The 3 key qualities of a great company are: 1. Quality of management. The management team is diligent, organized, and creative in developing market opportunities. They are also willing to take risks, which they research extensively. 2. Competitive advantage. There is a sustainable competitive advantage that sets the company apart from the competition. It's hard for new entrants to succeed because their products do not appeal to consumers as well as the company's products do. Return on investment is high due to low costs and high margins, leading to a strong cash flow. 3. Market creating capabilities. The business has a creative and innovative culture. They have an enviable brand that is well known and respected in the industry. It also has breakthrough capabilities to which other companies are looking for a way to imitate or copy. There are 2 types of investing strategies in stock market investing. 1. Growth investing is an investment strategy that focuses on stocks that have the potential for significant capital appreciation. Growth investors will buy stocks of companies with solid fundamentals, strong balance sheets, and high returns on equity. They also like to invest in companies that are undervalued, with a vision for growth and a competitive advantage. 2. Dividend investing. Dividends are payments made by a company as a return of its shareholders' investment. These payments can be in the form of cash, stock, or property and are distributed to shareholders according to the shares they own. Dividends play an important role in how companies distribute their profits to their shareholders. The idea of dividends can be traced to the late Middle Ages in Europe, where church authorities would collect tithes from parishioners for maintenance of churches and religious institutions. The word dividend first appeared in English in 1622 and is borrowed directly from Latin dividuum, which means a part out of. Dividend investing is a strategy of investing in stocks that pay dividends. It is often used by investors who want to generate a steady stream of income from their investment portfolio. There are many ways to invest in dividend stocks, but the most common way is through mutual funds or ETFs that specialize in dividend-paying stocks. These funds are typically passively managed and provide broad exposure to the entire market of dividend-paying stocks. Investors also have the option to build their own dividend portfolio by buying individual stocks, which means they can target specific companies that they think have strong fundamentals and will provide higher returns than the overall market over time. Different ways to invest in the stock market. There are many different ways to make money in the stock market, but there are some investment strategies that are better than others. There are 2 common ways to invest in the stock market. One is to buy shares of a company and hope the value of that company increases. If you invest in a company that increases in value, you can sell the shares of that company for more than what you originally paid. The other way to invest is to buy a mutual fund. A mutual fund is an investment where the broker will buy and sell different stocks for the person who invests. While this still requires money being put into the stock market, it is a much safer way to invest. A mutual fund can be used to hedge against inflation, or you can use it to diversify your investment portfolio. You will also have a variety of different stocks, which might help protect you from any one stock losing value. The sooner you start investing, the better it is. Whether you're at a young age and looking to set up your retirement fund, or an older person looking to supplement your income, investing is a great option. It's important to understand how much time you have before retirement and how much money you'll need so that you can plan accordingly. Albert Einstein once said, "Compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it." Compounding is a very important aspect of wealth creation in the stock market. However, it is not only a factor of interest gained but also of dividends earned. It is all about reinvesting either interest or dividends. Use the power of compounding to your advantage. Compounding is the process of generating exponential growth. It is a phenomenon that happens when an interest rate or return on an investment is reinvested and added to the principal sum, thus generating even more returns in the future. Make more money from your savings by reinvesting it. Investing in stocks, bonds, or mutual funds are all examples of compounding. So what does this have to do with your personal finances? Well, it can make a huge difference in your long-term wealth. When an investor buys stocks or bonds, they are buying a percentage of the company. If the company does well, the price of their shares will go up. The investor then becomes richer at a rate that is faster than the gain in their money would be if they were to leave it in a traditional savings account or use it to buy something. To start investing today, open a brokerage account or buy some mutual funds, and remember, it takes time to build wealth. Don't be in a hurry. Enjoy the process. If you enjoyed this video, hit the like and subscribe button and share it with others. Thank you and good luck with your investing and wealth building journey.